Welcome to TechnoFunda Decoded. In this video, we are going to understand one of the most important concepts in price action trading. They are demand and supply zones. Whether you're a beginner or a trader looking to refine your skills, knowing how these zones work can dramatically improve your entries and exits in the market. Let's dive deep into what demand and supply zones are, how they are formed, how to identify them, and how you can trade using them. First, what are demand and supply zones? Demand and supply zones are specific price areas on a chart where buying or selling pressure has been strong enough to reverse the price direction. A demand zone is a price area where buying interest is strong enough to overcome selling pressure. It's where buyers step in aggressively, pushing the price up. A supply zone is a price area where selling pressure overpowers buying interest. It's where sellers dominate, pushing the price down. These zones act like magnets for price action and are often used to predict reversal or continuation moves. Now, let's understand how these zones gets formed. Price moves in the market due to an imbalance between buyers and sellers. When demand exceeds supply, price moves up. When supply exceeds demand, price moves down. At certain price levels, big institutions like banks or mutual funds place large orders. These are not filled all at once. So, when price revisits that level again, the remaining unfilled orders cause the price to react strongly once again. These levels become high-probability reversal zones and show strong buyer support at that level. Let's visualize formation of demand and supply zones with an example. Demand and supply zones are formed after a strong price movement either upward or downward from a base or consolidation area. A demand zone is formed when price drops into a level, stalls for a bit, and then sharply rallies. This sharp rally shows that buyers are willing to buy in large quantities at that level. A supply zone is formed when price rises into a level, stalls, and then drops sharply. This indicates aggressive selling from that area. The base or consolidation area before the move is where the actual demand or supply was created. Now, let's identify demand and supply zones on a chart. First, look for areas where price made a strong move up or down with minimal pullback. Second, mark the base area where price consolidated or formed small-bodied candles before the strong move. Third, the top and bottom of this base becomes your supply and demand zone respectively. Fourth, extend the zone into the future to see how price reacts when it returns to that level. Let's understand the types of demand and supply zones in detail. First, fresh zones. These are zones that have never been revisited. They are also called as virgin demand or supply zone as they are untested zones by the price. They are considered the most powerful because unfilled institutional orders are still likely present. Second, tested zones. These are zones that have already been revisited once or more. Each time price hits the zone, it fills more orders, rejecting supply from that particular zone. Third, strong zones. Zones that led to a very sharp and strong price move, either upward or downward. It shows strong bulls or bears presence at that zone. Fourth, weak zones. Zones that led to a slow or weak move. These are less reliable. Now let's understand a key concept regarding demand and supply zones. How the demand becomes supply and supply becomes the demand. Interesting, isn't it? A key concept in price action trading is that once a demand or supply zone is broken decisively, it can flip roles. When a demand zone is broken and price falls below it with strength, that zone may now act as a supply zone. Why? Because the buyers who once saw value there may now be trapped, and when price comes back up, they may want to exit their positions, adding to the selling pressure. This is known as breakdown of the demand zone, as the price has broken down the buyer's area and now the price is in bear's hand. Similarly, when a supply zone is broken and price moves above it strongly, it may turn into a demand zone. Sellers who were short from that zone may want to exit or reverse, and new buyers may step in, causing the zone to act as support. This behavior is commonly referred to as a support resistance flip or zone flip, and it's a powerful concept for anticipating new trade setups. Now, let's come to the most important topic. How to trade using demand and supply zones in the market. First, find a valid zone using the methods described. Second, wait for price to return to the zone. This is what we call as retest of that zone. Third, look for price action confirmation like a bullish or bearish candlestick pattern, reversal structure, or volume spike. Fourth, enter the trade in the direction of the expected reversal. For a demand zone, enter long when price enters the zone and shows a bullish confirmation. Place stop loss below the zone. Target will be the previous swing high or a nearby resistance level. And for a supply zone, enter short when price enters the zone and shows a bearish confirmation. Place stop loss above the zone. Target will be the previous swing low or a nearby support level. Always combine zones with higher time frame analysis for better accuracy. Now I'll tell you which mistakes to avoid. First, do not trade every zone blindly. Wait for confirmation before entering. Second, avoid trading very old or repeatedly tested zones. Third, do not ignore overall market trend or structure. Always manage risk with proper stop loss and position sizing. In the upcoming videos, we'll dive deeper into how to draw these zones more precisely using multi-timeframe analysis and how to use them in intraday versus swing trading. If you found this helpful, subscribe to TechnoFunda Decoded for more real-world stock market insights. Thank you for watching.